Good morning. It's Friday, the 30th of May, and this is Govindraj Ethiraj, headquartered in Mumbai, India's financial capital, but in transit right now. The top stories and themes. The stock markets closed, but are after an extremely uncertain session. More economists are betting on an interest rate cut. Don't pop the champagne as yet on the court freeze on Trump tariffs. India's highest taxpayers are not those who you think they should be. And cancer cases in India are rising, and the increasing number of hospitals are not able to cope.
This is a core report with Govindraj Ethiraj.
Uncertain markets. The news from across the Atlantic was positive, at least for the day. A United States federal court ruled that President Donald Trump exceeded his authority with his proposed tariff plan. Although the White House appealed the decision, the ruling has raised hopes that Trump may scale back on some of those steep tariffs. In many ways, this is back to square one of an unpredictable board, but since markets live from day to day nowadays, today was a better day. Now, that did not really help the stock markets in India, who could not make up their mind which cue to go with, global or local or something else, though eventually they closed in the positive. The Sensex rose 320 points almost in the last minutes of trade to 81,633, while the Nifty rose 81 points to 24,833, below that 25,000 mark, which many consider an important baseline. Across Asia, the MSCI Asia ex-Japan rose about 0.7%, while US stock futures on Thursday indicated a positive start on Wall Street, according to Reuters, which also added that information technology companies, which depend considerably on the US, rose about 0.8%, were the biggest driver of the major indices on Thursday. Elsewhere, we spoke yesterday of several brokerages raising their outlook for India. Bank of America Global Research put out a note of part caution, which of course everyone else has been, when it said that while the structural drivers for domestic markets remain intact, they are cautious on domestic equities as valuations seem full and markets are ignoring risks of likely slowing global growth. After all, the Nifty and Sensex have gained about 13 and 14% respectively from their April lows, which, as you know, was last month. And one reason for that jump was the return of foreign flows. A consensus on a rate cut continues. A fresh poll of economists by Reuters says the Reserve Bank of India will cut interest rates on the 6th of June for a third consecutive meeting and once more in August to support a weakened economy. A large number of economists, 53 of 61 polled between May 19th and 28th, expected the Reserve Bank to cut the repo rate to 5.75% at the end of its June 4th to 6th meeting. Now, obviously, lower interest rates are good for economy in general and borrowers in specific, particularly if you've got home loans, then this is something that you should wait for. Transmission does take time, but it is good news. 2 respondents hoped that there could be a cut of 50 basis points and about 6 expected no change. So India's GDP growth is currently at about 6.3% for the last fiscal year from over 9% the year before. And inflation, of course, is below the Reserve Bank's 4.0% target or 4% target. So therefore, there is room to cut rates. Back on Thursday, the rupee weakened as the dollar firmed up following that court decision to block President Trump's reciprocal tariffs from going into effect. The rupee closed at 85 rupees 50 paise against the dollar, which is down slightly from its previous close of 85 rupees 36 paise in the previous session, according to Reuters. Don't celebrate yet. A court ruling that seeks to block President Donald Trump's Liberation Day tariffs represents only a temporary setback to his trade agenda and can be offset by other taxes, according to analysts at Goldman Sachs in a report on Bloomberg. The judgment by the U.S. Court of International Trade halts about 6.7 percentage points of levies announced this year, though the White House could use other tariff tools to make up for that, the Goldman economist said in a note to clients on Thursday. According to them, the ruling does represent a setback for the administration's tariff plans and increases uncertainty, but might not change the final outcome for most major U.S. trading partners. And for now, Goldman says they expect the Trump administration will find other ways to impose tariffs. The alternatives, and this gets a little specific, so let me just use one example, include the use of Section 232 levies referring to the charges on steel, aluminum, and auto imports on national security grounds. Even if all the pending investigations result in 25% tariffs and are added to the current levies under the section, that would add 7.6 percentage points alone, according to those Goldman economists. A panel of 3 judges has given Trump's team 10 days to halt tariff collection in a decision that the White House has already appealed. It also said that Trump wrongfully used an emergency law to impose tariffs on global trading partners. Record wheat and rice. India could produce a record 117.5 million metric tons of wheat in the year ending June 25, according to the government, above its March forecast of 115 tons, as higher prices led to farmers expanding the area planted with high-yielding seed varieties. India, incidentally, is the world's biggest wheat producer after China and produced 113 million tons of wheat in 2024, according to a statement from the government of India. Meanwhile, the country's rice production is also set to hit a record high, with the government estimating it at 149 million tons, up from last year's 137 million tons. We referred to some of these figures 2 days ago. Record production of wheat and rice will lift the country's total food grains production to 354 million tons from last year's 332 million tons, according to Reuters. A strong wheat harvest is also rapidly replenishing stocks, meaning India will be able to meet domestic demand without imports this year, contrary to market talk that it would need overseas supplies and a potential drag on global prices, according to Reuters. Do India's wealthiest pay the most taxes as well? The answer to this might surprise you. Journalist Puja Mehra, also host of How India's Economy Works, also on the core alongside us, speaks to economist and director of the Delhi School of Economics, Ram Singh, about why India's income tax base remains so narrow. The question is, why do the richest Indians pay a smaller share of their income in taxes than the middle class? Drawing on his research, Ram Singh explains how India's tax system unintentionally favors the wealthy and why income reporting has become less honest as wealth increases.
And your main finding, Ram, intuitively, I think all of us, even those who don't follow income tax data, etc., do suspect and believe that people who are wealthy and rich in India, the affluent, they tend to pay less income tax than legitimately they should, meaning to say that they're able to save on tax. But just how much this is, I think for me, that was a real surprise from your paper. I was expecting this, but not as much. First, what are the key findings of your paper on the missing income tax?
You are right about your observations on what people suspect. For me, also, the motivation was what I read in newspapers. So, several years ago, I read reports on who was the highest income taxpayer in India. I followed these reports over several years, and I noticed that highest income taxpayers are people who are celebrity. For example, a movie star, a cricketer. These are people who are well off, but if we ask the question, who are wealthiest of Indians? These people, celebrities, movie stars, cricketers, they are not wealthiest of Indians. So from media reports, it was clear to me that people who pay highest of income tax are not wealthiest of Indians and vice versa. And since income tax payment depends on income we report, therefore, it follows that even from media reports, it follows that people who are wealthiest of Indians do not report highest of income to income tax department. This observation raised my curiosity. I pursued it as a research question, and over the course of 3 years, I put together a large number of data using affidavits filed by people who can test election. I used statistics published by income tax department and Forbes list data. I put multiple data sources together to study relationship between wealth and income people report to income tax department. As you remarked very rightly, that it's not surprising that income wealth ratio, which is a ratio if we compare wealth with income people report, this ratio, income wealth ratio, comes down with wealth, meaning thereby this ratio is high for people with very little wealth, and it is very small for wealthy and super wealthy and ultra wealthy people. And the real surprise is not that it comes down, that this ratio comes down. The absolute levels are something that are striking. The absolute levels at, let's say, if we look at figure income wealth ratio for top 1%, wealthiest 1%, this ratio comes out to be about 2%, which is to say that in top 1% wealthiest Indians report income that is equivalent to about 2% of their wealth. If we consider even wealthier, 0.1% wealthy Indians, this ratio dips down to 1%. If we consider Forbes listed ultra wealthy, then this ratio falls, even it falls to a level half a percentage point, meaning thereby reported income is equivalent to about half percentage point of their wealth. This is striking because if we go back to our example of fixed deposits, hypothetically speaking, if someone puts all their wealth as a fixed deposit, they will be earning at least 7-8% by way of interest income only. So their income they should report should be about more than 7%, whereas actual figures are 2%, less than 2%, as we discussed. So that's the real surprise here.
And Ram, how is it for people who are not affluent, for the lower ends of the spectrum of wealth? The not so affluent, how much are they reporting their income as?
So the reported income of people, let's say bottom 10%, bottom 20% of wealth pyramid, bottom 10-20% of wealth pyramid, they report income which is more than 100% equivalent of their wealth. The real issue here is that bottom of the pyramid owns very little by way of wealth. Their major source of wealth is the house they live in, which are tiny houses, small houses in rural areas, even in cities, small cities, tier 3, tier 4 cities is what they come from. And the real estate value of the house, which is their main source, main form of wealth, is very small compared to income they earn. We must keep in mind that they do not earn a lot of income, but the value of their house is so small that even at minimum wage, their income is more than the value of their house. And as we move up the wealth pyramid, this ratio keeps on decreasing. Income as a ratio of wealth keeps on decreasing.
To listen to the full episode and that conversation between Puja Mehra and Ram Singh, the link is in the description. Moving on to a health issue, cancer. Roughly 1.5 million Indians contract cancer every year. In India, 1 in 9 people are likely to develop cancer in their lifetimes. Those who cannot afford expensive treatment are particularly affected, and there are many stories about how people travel long distances to reach hospitals and then have to stay on and take their treatments. Moreover, while the number of hospitals is increasing across the country, so are the number of patients. So why is that? Why does cancer require such specialized care, and what is unique to cancer apart from the obvious? In the weekend edition of the Core Report, I speak with Dr. Kailash S. Sharma, a near encyclopedia on the subject of cancer. Dr. Sharma was an anesthesiologist earlier at Tata Memorial Hospital and is now Dean of Academic Projects there. He's also a task force member on the upgradation of cancer care by the central government's Health and Family Welfare Department.
So we go into the, say, epidemiology of cancer and how many cancer cases per year in this country, maybe around 1.4 to 1.5 billion cases at any given moment. And with these cancer cases, the usual mortality happens between, say, 8 to 8.5 lakh per year. And these cases are every year increasing. They are increasing. There are two reasons. One, the population is increasing. Second thing, the longevity of the human being also is now beyond 70, 75. So there are few cancers which are related to, say, old age or because of some lifestyle diseases. Some are hereditary, some are genetic. So all these things considered together, we find that number of cases are increasing. Number two will be that when there were no major cancer hospitals in this country, all other country, all the patients used to come to Tata Hospital. So we used to find that these are the number of cases. But patients who could not approach Tata Hospital, they were dying in their home state or in their hometown and they were never get registered. So that time, the number of cases were not properly noted also. So that is a challenge. Second challenge is number of hospitals are required. Cancer care is such that to treat a cancer patient, a comprehensive cancer hospital is required. Comprehensive means there should be 3 core specialties like surgical oncology, medical oncology, radiation oncology, and very important branch, which is often say neglected, is oncopathology. A pathologist has to be so well trained that oncopathologists will give the guidance that what type of cancer, whether it is invasive, non-invasive. Then there are immunohistochemistry markers. Then there are molecular diagnostic markers, which will give the correct diagnosis, the stage of the disease. Then the prognosis also will be marked on whatever the number of tests. So these are the things. Then of late, maybe say 20 years back, we realized that there is a department which is very much needed, is a department of palliative care. So with all the department, that oncopathology, 3 major core specialties, and palliative care, they are the pillar to manage any comprehensive cancer hospital. So Tata Hospital has its own history. Way back in 1939, with House of Tatas, it was founded by them. And then by 1962, it was handed over to Department of Atomic Energy. And now it is a standalone cancer hospital under administrative and financial control under Department of Atomic Energy. So we were the only person available in this country to manage. But for last, say, maybe 20 years, there are large number of cancer hospitals in this country which are under government organization, whether it is state government, whether it is central government, or maybe under public sector undertakings. But there are large number of private corporate hospitals also, not full-fledged for cancer, but they are a multi-speciality hospital having a small cancer wing where they have got 3 or 4 specialties available, and then they manage the cancer care there. So presently, with number of cases and number of hospitals, what we want that to cater to this load of cancer, the availability of a cancer hospital should be in public domain, and they should be available by government so that you can treat them cross-subsidized, highly subsidized, very poor patient, non-paying, and under government scheme also, like PMJ scheme, Mahatma Phule, Arogyashri, different schemes are there. So at any given moment, when I saw all these hospitals, more than 85% patients are under schemes.
Right. So when we say that we have about 1.5 million cases every year, so you're also saying that roughly 50% is the mortality?
Yes, around 8 to 8.5 lakh cases every year.
Okay. So is this uniform across types of cancer, or is it are there some kind of cancer within that which are more?
So, good question. I will touch upon, say, 4 major and common cancers. One is, say, head and neck cancer, which is because of the smokeless tobacco or smoking tobacco, the pan chewing, betel nut, all these habits. Second will be breast case. Then third will be hepatobiliary, like colon cancer, pancreatic cancer, gallbladder cancer. And fourth, if you want to touch upon, it will be major gynecological cancer like cancer cervix and cancer uterus, endometrial and all.
And before we go, here is some feedback from you. So thank you all as always for sending in your feedback, and all of this serves as an encouragement to us. Manoj Jha says, I suggest a show on analyzing big ticket acquisitions by Tatas and Birlas, Chorus, Jaguar, and Novelis. Was this the right strategy? Well, yes, indeed. It's a good question to ask today since enough time has passed. And were these acquisitions worth the money and, of course, the time and effort that went in later to complete the integration and ensure that the companies on both sides worked smartly? After all, mergers and acquisitions are tricky. Rohit Patpidri asks, a good question to ask is how many of the 91% are first-time buyers? My guess is the shift is transitory as many are looking to upgrade only as it is a buyer's market now. He's referring to our story where he talks about how, or rather a survey that showed how a lot of young buyers are attitudinally shifting back to buying homes as opposed to renting them, apart from the fact that Indians generally do want to own homes more than before, at least as per that survey conducted by Knight Frank. Srinivasan PR says, cross-country transfer through blockchain or otherwise requires tie-up between central bank for credit risk, and already China has digital yuan with 6 countries. So he's referring to our conversation around blockchain and the use of it for creating identity and financial inclusion. We've been doing several discussions on this theme, so I'm not sure which one Srinivasan is specifically referring to, but the point is taken. SP Singh says, India Inc. has been sitting on a mountain of cash over the years, but only prefer to acquire rather than spending on R&D for innovation. Most risky is private investment in defense because Indian corporations, by and large, don't have the right very long-term approach to wait for returns. SP Singh is referring to the take on Thursday morning, which speaks about how Indian companies are holding back their investments in India, but are investing overseas. And that number has been rising quite sharply, though mostly small investments and mostly in financial services from what the data says. SP Singh's point is that Indian companies have preferred to acquire rather than spend on R&D, which is technically correct because R&D spending has never really risen despite the rising size of balance sheets. And yes, it is also a fact that acquisitions have increased. But this is, of course, something that is worth diving deeper into and on a more continuing basis. So that's all we have time for. Thank you so much, everyone, for your feedback. And like we said, it's encouraging and most useful for us. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.